All right, do we have everybody?
They're coming in.
All right.
The participants are joining. It's nice to see everybody tonight. Nice to have you.
Welcome, welcome.
All right. As we kick off here, Katrinka, should we make sure that the chat's working?
Yes, so those of you that are joining, feel free to, we want to make sure that the chat's working so that you can answer questions or ask questions. So pop into the chat. Let us know what state you are joining us from tonight.
Yes, and I'd also just add, we're going to go over a lot of information. Hi, Utah, Colorado. Hey, Jody, Arizona. Way cool. As we go through this content tonight, some of it's pretty deep, and sometimes we fly a little too fast. So feel free to pause us. Feel free to ask questions in the chat. You're welcome to do that. You also have the ability to raise a hand if you want us to call on you and if you want to ask a question. So, and in my screen, as I'm looking at my screen, down at the very bottom, there's 3 little buttons that say more, and then it says raise hand. So hopefully you can find that, and we'd love you to be as interactive as possible. And yes, Jody, we are recording this, so we can definitely get you a copy of this as well.
Absolutely. All right, should we go ahead and kick off, or should we give everybody a minute to keep streaming in?
I say we rolled. We should honor the people who are on time.
Okay, absolutely, absolutely. Well, welcome everybody. We're super excited to have you here tonight. Tonight, we're going to be sharing some strategies and ideas on building a secure retirement, hopefully making work optional for you so that you have the capacity to check out and enjoy your later years in life doing whatever you choose. And so some of the problems and challenges that we're going to be addressing tonight are how building a secure retirement has changed. So like problem number 1, pensions. Pensions are historically not around anymore. They really don't exist unless you work for a government entity or maybe you're a school teacher. So how pensions have changed and how we have to plan for retirement differently. The risk that when we get to retirement, if you're going to have enough money, and so that you don't outlive the money before you finish out your life. And then the last one in inflation, how that is impacting our retirement accounts. So to share, the first half of the presentation is going to be a little bit deep, like Josh said. And we want you to stick with us because a lot of the meat and potatoes and the really exciting parts is going to get to us towards the end with some of the strategies. But we kind of need to get through where we're at with building retirement accounts and how things have changed to bring you along to some additional ideas. Quite honestly, truthfully, I feel like I started planning for retirement later. I would call myself later middle age. And so I don't think that I started planning for retirement seriously enough. And so I'm playing the catch-up game. So wherever each of you are in your journey to building retirement, if you haven't started at all, if you're just beginning, joining this webinar to get some ideas, or maybe you've been planning for several years and you're looking for some additional revenue streams in retirement, stick with us because this is going to be a really fun journey tonight, and we invite you to ask questions along the way. I would like to introduce Josh Metal. He is a dear friend of mine, my mentor, division president of Neo Home Loans. He has taught me all of the strategies and skills and is actively living what we are teaching you tonight. He pushed me to do the same thing. And so I'm about 3 years into the strategies that we're going to be talking about tonight. So welcome, Josh. You want to say anything?
Sure. Great to be here with everyone. And yeah, as Katrinka said, as I pushed Katrinka into getting into real estate investing, my mom did the same thing for me 22 years ago. And my mom and I started building our real estate portfolio when I was 20 years old. And we still own virtually every property we've ever purchased over that 22-year period. So a lot of the research and the ideas that we're going to present to you isn't just from the perspective of a mortgage lender. It's really from the perspective of an advisor. And over the last 22 years, my mother, myself, my wife, we have accumulated and now own and manage over 200 rental properties in Utah. So everything from single family homes to retail office buildings at office centers, not retail office, I'm sorry, retail shopping centers, the word I was looking for, that Katrinka and I are partners on, and all kinds of medical office spaces and buildings. And so really the content that we're sharing with you is not just theoretical. It's half, looking at thousands of clients and how they may be behind and where they want to be in retirement, and seeing it from that perspective, but then also seeing it from the real life investor perspective over a very long time horizon. I think that's the value that I can bring to you all this evening. So we're excited to share with you, and I think we should kick it off.
All right, absolutely. So I'm going to go ahead and share my screen here. Okay, give me a thumbs up if you can see that.
It's coming up right now. Got it.
Okay, perfect. So as we mentioned, the topic of conversation is building a secure retirement and making optional work. So let's jump in. Tell me if that is switching yet for you, Josh. There we go. You good? Okay.
Gotcha.
All right. So we're going to talk about the old way of building for retirement. And as an example, so the way I was raised, the way my parents were raised, was essentially take on student loan debt, get a degree, take on your W-2 job, work, build retirement through contributing to a 401k, saving money, getting an IRA if you can, paying off debt so that when you get to retirement age, you don't have a lot of debt to cover. And hopefully you saved enough and that you don't outlive your money. So that's the old way of doing things. The new way, and what we're proposing, is get an inspiration or mentor that can coach you and guide you. I've got mine in Josh. I have some great colleagues who have turned on the passion button for me when it comes to investing in real estate and really seeing it work for my family. So make sure that you get someone in your life. If that's a financial advisor, if it's me, I hope it's me, and I can help you with that. Also having somewhat of an entrepreneurial spirit, side hustle. What are other ways that we can bring in some income, even if we're just working a W-2 job? Building on financial literacy. The more you learn, the better strategies you're going to be able to take advantage of, and the likelihood of you being successful in retirement is higher. So you just being here tonight and building your financial literacy is step one. So good job there. Leverage, we'll talk about leverage and leveraging some of our assets to help build cash flow in retirement and how we can show income there. And then investing. Anything you'd like to share there, Josh?
Yeah, I mean, I think there's an adage out there, a school of thought, if you will, a sacred cow, that we have to get rid of debt at all costs. And we're going to show you some data today that might not be serving people as well as they think. So it's important to get rid of the bad debt. Bad debt is anything that isn't going to create cash flow or wealth in your life. But we need to be able to bifurcate bad debt from good debt. And that leverage is what enables you to make outsized returns and create an inflation hedge with real estate. So we're going to get deeper in that, but that's a really important one, Katrinka.
Likewise. Awesome. Okay. So we're going to start off by explaining the 4% rule. The 4% rule for retirement is essentially, think about what you may need to live on in retirement. In this example, we're showing you, okay, if you need to live on $40,000 a year in retirement, the 4% rule states that you can withdraw 4% of your total nest egg or your retirement account in the first year of retirement. And then you slightly adjust those distributions over time with inflation. So you notice that it ticks up a little bit over time. Another way to look at that is take what you need to live on, like I mentioned, the 40,000 times 25. Okay, 40,000 times 25. If I do the math right, I believe we are at $1 million, or is it 1.5? Okay, so 40,000
A
$1
million.
million. You'd need $1 million in retirement to be able to have $40,000 a year to live on. Now think about, can you live on $40,000 a year now? And how that might change over time. So by withdrawing 4% of your investments during the first year of retirement, subsequent years you increase for inflation. By following this formula, you should have a very high probability of not outliving your money in a 30-year retirement. Any questions there?
No, I think you explained it really well. This is just kind of a benchmark because the starting place is, well, how much assets do I need? Well, it depends how much income you need. So this is just a great fundamental rule. You can say, if I want this amount of income per month, this is how much I've got to save in terms of those retirement assets.
Yep, exactly. This comes from the Charles Schwab website, and I thought this was actually really a cool concept. The planning time horizon is on the left side. So if you think you're going to have a 30-year retirement versus a 20-year retirement versus a 10-year retirement, and your asset allocation that you invest in is moderate to conservative, so we're not getting crazy aggressive, it shows you roughly how much you can draw starting that first year of retirement. So if you're going to have a 30-year retirement, you can draw 3.4 to 4.1% of your total nest egg per in the first year, and then it'll increase with inflation over time. So if you're 55 or 60 and you're late in the game and you're just starting to get into saving for retirement, or you think your retirement is going to be a shorter time period, you can withdraw a little bit more, but I'd say we would lean more towards the conservative of around the 4% per year. What I also think is very, very interesting is at the very top, there's a 75 to 90% confidence that you won't run out of money. That's a 1 in 4 or 1 in 10 chance that you could run out of money, which is kind of spooky. That caught me right between the eyeballs. I don't know how about you guys. Anything you want to comment there?
Yeah, 1 in 4 chance of outliving my nest egg is not a risk that I'm comfortable with, for sure. We gotta find another plan to get around that one.
Agreed. This next slide, this was the one that was just staggering to me. When you really sit down and you start doing the math and understanding what you can live on today versus what you need to have available, considering inflation over time, this is the one that got my attention the most. So let's start with column 1. If you can currently live on $5,000 a month today, you would need $1.5 million in retirement by the time you retire. If you live on $10,000 a year or $10,000 a month, which is $120,000 a year, you need $3 million sitting in your retirement accounts to be able to take distributions. $15,000 a month, you need $4.5 million. But here's the kicker. Assuming a 2.5% inflation in 30 years, that's 2.5%. So average. What about these years that we're in right now where we're in an inflationary environment and inflation is significantly higher? So even with only 2.5% inflation, the $5,000 a month that I live on now, in 30 years, I'm going to need $10,487 a month to live the same lifestyle in retirement that I'm used to living now.
Yep.
I like my lifestyle. I'd like to protect my lifestyle. I don't want to live on ramen noodles when I'm retired. So this was really a staggering figure that not only is our monthly income, but as well as the assets needed that we need to save up for is more than double if we've got a 30-year time horizon. Crazy, right? Any questions there?
It's really crazy. And I think a lot of people don't realize that inflation, especially now that we're going into a period of elevated inflation, it feels like how much it erodes your purchasing power. And the realization that if you want to live on a $5,000 a month lifestyle, today's purchasing power with $5,000 is going to take over $10,000 in income 30 years down the road. And that means that you're going to need more than double the amount of assets. That's when those numbers get kind of spooky. And we're going to go into kind of running some different pro formas, if you will, on how to save this kind of money. And the reality is somebody on a $5,000 a month budget just really can't save enough to get to $10,000 a month in income, which is what you're going to need to have the same lifestyle in 30 years.
Agreed. Agreed. Okay. Next slide. And then Josh, did you want to share this in a live to be able to show this slide live?
Yep. And Thomas Russo, that's really kind of funny. Thomas Russo just put a comment in the chat, said, you know, adjustment for inflation is clear to most. What about adjusting withdrawals based on account balance fluctuations? Withdrawing in a down year is damaging. Yeah, so you nailed it. That's literally right where we were going with this, Thomas. And yeah, Katrinka, if you'll quit sharing just real quick, I will jump on and share this little interactive graph. And what we're looking at, what was on the slide, and what I'm going to share on my screen here is a chart of the S&P 500. This is the Standard & Poor 500, the biggest companies, the 500 biggest companies in the United States. And this graph goes back all the way to 1928. And what Thomas was alluding to is called sequence of return risk. I know, it's Wall Street. They like big fancy names that are hard to remember. But what sequence of return risk means, and you know, Katrinka alluded earlier to that Charles Schwab diagram that said, hey, if you're going to live 30 years, you can withdraw this amount. If you're only going to withdraw on your savings for 10 years, then you can withdraw more. And we have a 75 to 90% probability that these numbers are right. Well, why? It's math. Like, couldn't we just divide that out and figure out how many years it's going to last? Well, not really, because of this thing called sequence of return risk. So picture this, right? You know, over the long term, hey, the S&P 500 has delivered over a 10% return over the long return. So that's great. But we have these periods where, you know, back in 1930, S&P 500 was at 408, as high as 500, but then crashed all the way down to 125. And then, hey, we've had a heck of a run here. But here's the risky part, team. If this is the year you retire, let's say we retire in 68, 67, and the S&P gets as high as 862, and you start withdrawing money, that 4% or the 6%, depending on how long you think you want to draw down those assets. But if you're drawing down those assets, especially at the beginning of our retirement, and the stock market is going down. So in this illustration in 68, the stock market went from 870 to 327. So, you know, we're talking about a 65% decrease in stocks. And if you're drawing your retirement funds during a decreasing or what, you know, they call bear market, that's when the prices of an asset are going down, then what we've modeled perhaps would last you 30 years, well, heck, it might only last you 15, because you're drawing down those funds during those down years. And here's what's scary, Katrinka. Like, if this is when we started retiring and we started drawing down those assets in 1968, it didn't get back to this 870 range from 68 all the way until we're talking 90, 91, 92. So you're talking about 22 or 23 years it took to get back to that period. So, hey, no problem, right, Katrinka? Just don't spend any money for 23 years. Problem solved. Most people need to eat. And then again, hey, this happens, you know, this isn't the only time in history this has happened. Here it is, July of 2000, S&P's at 2468. That's kind of a top, let's call it 2,500. Well, it doesn't get back up to 2,500 until 2014. So, you know, you're talking about another 14-year period. So, you know, we don't know. What does this look like? You know, is this a where we are right now? Is this just a 1-year retraction, or is this prolonged? You can never tell. So what we're suggesting here is that we need to have a backup plan. Go ahead, Shrink, if you want to take over the share again. We need to have a plan so that the only thing that we can survive on in terms of liquidity and retirement is stocks. And if the stock market's in a really bad bear market, a downward market, how else could we, get through weather the storm and get through those hard times?
Yeah, and to note, the average return for the S&P 500 is around 10 to 11%, since its inception in 1957. And year to date, I don't know if any of you are paying attention to your 401k or your stocks this year, but year to date, we're down through October about 24.8%. We've had a nice little run the last couple of days, but it's generally down 20 to 24% year to date. So that's a little spooky for those who, started retirement in the last year or two. They're well into it, and now they're losing a decent amount of their nest egg. Any questions there?
I think you nailed it.
Awesome. This is a really cool tool, guys. If you want to hop out and run any type of really cool investing calculators, this is from investor.gov. You can go out and run different scenarios for you personally on what you think you might need to invest. I did this for myself and my family, and I thought it was quite interesting. So for example, in this tool, if I need to have $5,000 a month in today's dollars, assuming 2.5% inflation, so I need to have a total of $10,487 by the year 2052. What this is telling us is you would have to put in, if I started at $1 and I had a 30-year time horizon for savings, and we had an average interest rate of 8%, I would need to invest $1,154 a month. Think about that, guys. That's like nearly half of take-home pay. Like if I earn $5,000 a month after taxes, that's about 50% of my take-home pay and my earnings that I would need to be putting and setting aside for retirement to be able to live the same lifestyle that I am today. After 30 years, what this is telling us that we would have 1.57 million saved up at the end of 30 years. Questions there?
No, that's great. And if we apply that 4% rule to 1.57 million in savings, that's going to give you about $5,200 a month in income. So if we're going after that bogey of 10,487, this gets us about halfway there to the lifestyle that we're going to need 30 years down the road, right?
Again, like wrap your head around that. Set aside 50% of your take-home pay now, and that's still only half of what you're going to need in 30 years. Crazy.
Yeah, and perhaps that 1152 could be 401k. So maybe that gets netted out before they pay taxes on it. But it's still, I mean, it's still 20, 22, 23% of income. The reality is it possible? Yes. Are most people doing it? No, right? It's not really working well for the US general public.
I would argue that the lion's share of Americans are not disciplined enough to be able to save this much and not dip into it before retirement. Okay, the second half of the puzzle, Social Security. If you guys haven't done this yet, go out to the Social Security website and you can actually create your own account and log in, and they will show you what your projected benefit is going to be at retirement age. So with Social Security, you can take an early benefit. So at the age of 62, you can start drawing. Full benefit currently is at the age of 67, and then you can delay taking your benefit and get a little bit more if you delay it until you're 70. Now, this is assuming the current state of the Social Security system. I don't know if you guys have heard about it in the news, but for me, I don't feel comfortable banking on this system being in place in the current state at the time that I'm ready to retire. I'm skeptical, and I maybe it's that I don't trust where we're going with it, but I can't rely on this and hope that this is going to be here. I feel like I need to have a backup plan in case the system either breaks or is adjusted, or maybe they change the age in which we can start pulling from retirement, because the inherent problem here is when the system was put into place, people weren't living as long as they're living now. And so now we have more in the system drawing benefits. And so Social Security could be a catch-22 in the end. Any questions? But go out to the Social Security website, because it was really cool. It shows you all the years that you contributed since you started working. It tells you if you have your 40 credits required to be able to get Social Security benefits, and then what you would be projected to make between now and retirement, what they're anticipating you contributing, and what your ultimately your benefit is going to be. It's very, very interesting. Any questions there?
No, that's great.
Okay. All right, this is similar, also from Social Security Online. So in essence, your estimated monthly benefit beginning at the age of 65. So this is about 30 years from now. If you were born in 1987, your current earnings were $60,000 a year, okay? And your retirement month was 30 years from now. Roughly, your monthly benefit will be around $52.54. Okay, so that's going to make up the other half of the equation of our 401k and stock distributions. $52.53 from the stock portfolio, $52.54 from our Social Security, and that does get us to the $10,487 that we would need to have 30 years from now. That's assuming we currently live a $5,000 monthly lifestyle, and we plan on living the same lifestyle in retirement. Questions there?
Yeah, I mean, for me, it just provides a tremendous amount of uncertainty. It's an untenable risk for me that all of my assets are in traditional stocks and bonds that I can't control if there's a bear market, but I know that I'm going to need access to that money. And you know, as the Charles Schwab said in that calculator, you know, we have 75 to 90% certainty how long these assets are going to last. That's an untenable risk for me. Another untenable risk for me is the reality that I don't know what form Social Security is going to be around in when I start drawing it, but the mathematical equation is there's not enough money there to pay out the benefits that those IOUs, there's not enough money to pay them out. And so those are two big question marks that I just want to hedge against. I'm not saying these aren't viable. Certainly a lot of people have been successful with them, but it causes enough risk and trepidation for me that I want to have another lever I can pull to be safe.
Agreed. All right, guys, this is from Vanguard, and this shows us essentially different age categories of Americans and how we're doing saving. So in the left-hand category, your rough age, the median, which is the middle category or column. This is essentially 50% of the people are above this mark, 50% of US Americans are below this mark. So let's take the 65 plus. So 65 plus age group, median savings is 87,000. And we take the average, which is the far right column, and average, this is like the best savers, the most income set aside, the most savings, the most assets compared to the least. And it takes an average.
Yeah. And
the average in the 65 category group is 280,000. Now, didn't we just say that we needed $1 million just to pull in 40,000 a year?
$3,500 a month. That's it.
Do the math on 280,000 savings. That's roughly 10,000 a year, people. That's like $900 a month. So the average 65 plus of Americans, like, I don't know how they're going to live on it. So that's essentially what we're looking at with savings. So people are not consistently saving enough, which was our argument earlier, that we're just not disciplined enough. And the sequence of events is very risky. Yeah. Any comments there?
Yeah, I mean, the takeaway that I see, and this is supported by this data that we see here by CNBC, this poll, but we see this all the time. I mean, it's unfortunate, but we see thousands and thousands of clients applications in their retirement accounts. And the reality is just the vast majority of them you look at and you go, even really a lot of really successful doctors and dentists and medical professionals that we serve, so many years going through school, so many years paying off that student loan indebtedness. Then they start saving. And what we're suggesting is that you can, if you start really early saving and you save for a really long time and everything goes right, that's a great strategy. But we're not seeing people do that as often as we would like. And that's kind of the whole genesis for this. And so we said, all right, well, if this is the numbers, if this is what we're seeing on loan applications, this is what CNBC is telling us, what other approach might there be out there to find a solution to this issue that is pretty widespread across the country?
Agreed. So we're going to suggest there's roughly two paths, two camps. So path one, invest in stocks, bonds, mutual funds, and build a portfolio of assets until you retire, at which time you start drawing on those assets and hope you die before your money runs out. That's what we've been talking to up until this point. Path two, purchase a few homes that generate cash flow over time and allow the cash flow to fund your retirement. Then when you pass on, your heirs get the properties and the cash flow, which does not run out if the property is maintained and operated like a business. I'm going to suggest both. Do both. Path three, do a little bit of both. There's an easier way than saving 50% of your take-home pay. And honestly, the math is just kind of scary by investing in stocks alone, because you're going to have to bear those ups and downs and the ebbs and flows in the market. So we're going to jump into doing both, or the real estate arm, next.
Yeah, and the place where people that go all in on real estate sometimes get in trouble is because they have a lack of liquidity outside of real estate that they can draw on if there's some sort of a catastrophe or an emergency. So both is the right solution for me. I want to have assets in real estate that we're getting paid in these, the 5 ways that Katrinka is about to tell us about. And I want to have a nest egg outside of real estate so that I can draw those assets when the stock market's high in retirement, and I can draw off my rents when the stock market's low. And I have some diversification in case something happens bad in one asset class and I want to, leave it alone for a while.
Absolutely. So I don't know if any of you have read this book, Rich Dad, Poor Dad. Amazing book. I've got 4 teenage daughters in my house, and I'm actively paying each of them to read this before the end of next summer. So we're reading a chapter with each of the kids and then going through it, because one of my colleagues, a friend of ours, his dad paid him $100 to pay it to read it in high school. And he says it's one of the best books that he ever read that launched his financial literacy at such a young age. So great book here. But Robert Kiyosaki essentially states there's 5 different ways that real estate pays you, not just 1, but 5. The first one, appreciation. Obviously, the property value goes up over time. There are going to be times when it goes down, but in general, real estate increases over time. Okay. Amortization. This is your mortgage balance being paid down. And thankfully, when you have an investment property, you're not the one paying that down. Your tenant is paying your balance down for you. Cash flow. Cash flow is the difference between your expenses versus the income that you're bringing in, the rental income coming in. Okay. Depreciation. Depreciation. I mean, we could do a whole webinar on this, but it's a very, very powerful tool if you understand IRS rules and codes. Depreciation is essentially just taking a loss on your properties that you didn't have to incur in your bank account while the property is still appreciating. Some fun strategies, if you want to reach out to me after this webinar that we can talk about. Josh taught me about this, rolled out cost segregation and long-term bonus depreciation on my properties this year. First taxes that I've done that on, and it's a really great way to save on your taxes. We'll get into that on another webinar. And then the last one is rent inflation. Rent inflation is essentially how much you can charge in rent, and it increases over time. I believe Zillow said this year we're sitting right around 8% rent appreciation. Do you know what it is historically, Josh?
I think in the US, it averages around 4%, pretty close to the national real estate appreciation rate, which I think going back over the last 30 years is about 4.9%. In Utah, we've been blessed. You know, we have the fastest appreciating residential real estate market anywhere in the country over the last 30 years. And the rent appreciation in Utah has been closer to 6 or 7% a year.
Yeah, amazing. So essentially, you guys are your income is going to increase with inflation over time. So rent inflation continues to pay you. A great quote from Warren Buffett. He said that a 30-year mortgage is a very powerful tool. It allows you to fix your costs. Okay, fix your costs and then when inflation goes up, rates come down. You can refinance your mortgage, fix that payment at a lower monthly liability, which increases that cash flow. He calls it a one-sided bed.
Yeah, and if you don't mind, this is the rent inflation is the one that I'm the most passionate about. So if you don't mind, I want to just give a 30-second story of what this looks like over 20 years. You know, one of the very first properties my mom and I bought together was an 8-plex on the side of Capitol Hill in downtown Utah, Salt Lake City. And when we bought that building, the average rent in those units, they were going for about $275 to $315 a month. So, you know, if you figure average, let's just call it $300 a month times 8 units. So we're talking about $2,400 a month in rent for that entire building. Well, fast forward now I think we're 21 or 22 years, probably 21 years into that building. The average rent on that building is about $1,400 a month. So if you think of that over time, that rent went from, you know, $2,400 to over $11,000 a month in rent, while at the same time, the balance of the mortgage has gone down tremendously through amortization. And as Katrinka alluded to, we've refinanced several times and gotten the rate lower and lower and lower on that debt. So rent inflation is the thing that I hear people talk about the least, but I actually think it's the lever that has the greatest impact on your retirement, and it has the greatest protection against inflation.
Yep, agreed. And I just wanted to touch on briefly the rule of 72, if none of you know what this is, but it's essentially talking about when an asset class will double. So for example, let's say the average home appreciation historically is 4%. 72 divided by 4% states that the value of your house will essentially double every 18 years. 18 to 20 is the average. Let's talk about the S&P 500. If it averages 10% appreciation, 72 divided by 10, the average time it will take to double your assets in stocks, about 10 years, 7.2 years, roughly. So that's the rule of 72. Anything there, Josh?
I was just looking for average rent increases. And yeah, I mean, the recent rent increases are clear up around 8-9% is everything that I'm finding. But I'm going to look and see if I can find some other historical data going back further than that to give a long-term rent increase. But the same thing applies, that rule of 72, the same thing applies to rent. So if you want to know how much your rent's going to go up or when it's going to double, you would take whatever rent increases are common for your area, divide that by 72, and that's how many years it's going to take for your rent to double. So just another way to look at that.
Yeah, so applying that here, if it increases 8% per year, rent appreciation, 72 divided by 8, you can plan on your rents doubling about every 9 years. But you'd have to look up your specific area and what rents are increasing. Okay. Next. We put together a case study, pulling all of these items together on how real estate pays you. So the first one, appreciation. So this assumes we bought a $600,000 property this year in 2022. And let's say that we have 4% annual appreciation. In 20 years, that house is going to be worth 1.34 million. Okay. So there's the appreciation arm.
Not bad.
That's beautiful. Amortization. Okay. Keep in mind that if you purchase the home for 600,000, assuming the loan amount starts at 480, say you put 20% down because it's an investment property, and we just threw in a rate here, say 5.5% interest rate. In 20 years, your $480,000 loan balance, you're only going to owe $251. And guess what? You didn't have to pay that. Your tenant paid that for you. Very cool.
Very cool.
Cash flow. Okay, this is the rental income that we're talking about. And in this example, we're only using 4% annual increase. So let's say we have rental income of $2,800 a month. In 20 years, if it increases at 4% per year, your rental income is going to be $6,135 per month. Okay. Again, Zillow is showing average of 8%. So everybody's area, areas of the country are a little bit different. So something that you might want to look into as you start investing. And then you bring all of these together, and this is where the sweet sauce happens. But having this one property that you bought for $600,000 is like having $1 million in a stock portfolio. Okay. After 20 years, the home value is going to be 1.314. You're going to owe $251. So you have roughly $1,050,000 roughly in equity. Your rental income is increased up to $6,135. And with a fixed mortgage payment of $2,725, that's monthly cash flow of $3,410. Okay. And I'll get to the cash out option here in a second. But if you take the 4% rule at $3,410 a month, this equates to having $1,023 in that stock portfolio. It's a little more than $1 million. Isn't that crazy?
That's crazy.
Crazy. Go back. The bigger kicker is this one. Let's say at the 20-year mark, you guys want to dip into that equity that you have in the property. Like you can only tap into 75% of the equity on an investment property. So if you wanted to cash out 75%, you could dip into and take out $734,000 in cash. Okay. That would push your monthly payment to $5,593. You're still cash flowing about $500 a month, because at that point you're making $6,135 a month. So the cash flow from your tenants is still covering that payment, and you're going to walk away with $734,000 cash, tax-free.
Yeah.
Tax-free. Crazy. You essentially just created your own pension with one investment property.
Yeah, and the cool thing about this is that, this doesn't take into effect or into account, potential expenses having to do with the rental property. So if you're not managing it yourself, maybe you're gonna have some expenses there. So that's true. We should definitely get that out on the table. But the other thing this doesn't take into account is that over that 20-year time horizon, this assumes that the mortgage payment stayed the same. But the reality is, the way the economy works is we have times of inflation that causes rates to go up. We have times of deflation that causes rates to go down. And I will tell you, every property that I've owned for 20 years, I have refinanced multiple times to lower interest rates. And as I refinance to lower interest rates, what I typically do is pull out more cash that I use, by the way, tax-free. I can borrow that, in this analysis where Katrinka said you could pull out $734,000 cash in hand, tax-free. You haven't sold the property. There's no taxes on that event. But that's the thing I've done. As rates go down and the value of the property goes up, you find one of those golden opportunities, you refinance, pull cash out, and you go buy another investment property. So this is like a snowball. You have to get in the game to control an asset, and you have to have positive cash flow, and then you're patient. And then there's these opportunities and times that come where you either refinance to a lower rate, lower your payment, and increase your cash flow, or you say, hey, I need to go get another rental property, and you use that cash-free money that you extract out of the equity home to go acquire another property and continue to build the cash flow. So it's all about controlling the asset and then being patient and watching what the market will give you.
Yes, and it's also the assumption that we're buying real estate and waiting. We're holding. I'm not into flipping. I'm into obtaining an asset and letting it grow over time. Quick story, December of last year, my property, my primary residence that I've lived in for 20 years had a wicked amount of equity in it. And I was on a 15-year loan. I had a 2.625 interest rate. Beautiful, right? I was starting to look at how behind I felt like we might be in creating some of this wealth for retirement. So dipped into the equity of my property in December. And in February, March, and April, my primary residence bought me 3 investment properties that are currently cash flowing to help me front load my retirement. The cash flow that is coming in on those 3 properties is greater than what my payment increased on my primary mortgage. Yes, my rate went up because I refinanced when rates were higher, but my rate went up and I'm still actively cash flowing. And now I have 3 additional sources of income coming into me and assets and equity building. So it's like peeling dollar bills from the sheetrock of your house, right? Equity is amazing, but it's dead money. So for me, I decided to make my equity work for me. And now I have assets buying my assets for me. Think of how long that would have taken me to save up 25% down for 3 of those properties, like a long time. Instead, I'm leveraging an asset that I have, which is my primary residence, and it's now buying assets for me.
Powerful.
All right, stepped up basis and generational wealth. So one really cool thing about real estate that a lot of people don't realize is we can change the lives of our children and our grandchildren. It's a multi-generational wealth building tool. The stepped up basis is essentially an adjustment to the value of the appreciated assets upon inheritance. So using the same example that we did in the case study, let's say you purchased that home for $600,000 this year in 2022. And in 2042, in 20 years, it's worth $1.3 million. Remember, the loan amount was $250,000, okay? And the equity we had was around $1.05 million. Let's say at the time of my death, so this property at the time of my death, if I don't sell it and I pass it on to my children, my kids have the opportunity to sell it after I die. And if they do, they get what's called a stepped up basis. So my assets will be appraised at the time of my death. And the value that the kids get is the value of the property at the time of my death. They even wipe away depreciation that I've already claimed on the property on my own personal taxes. I'm gone now. The property goes to my kids. If my kids choose to sell it after I die, they get that stepped up tax basis. Okay, so the value of the property is $1.05 million at the time of my death, and it starts there for the kids. So they could sell the property at $1.05 million minus the $250,000 that they owe on the property, and they get $800,000 in inheritance from me tax-free. Or what I will clearly coach my kids on doing, don't sell it. Don't sell it. Keep the passive income coming and allow that monthly income to subsidize my kids' lifestyles. Okay. Or conversely, the other side of the coin is, what if I do sell it when I get old? Maybe none of my kids want to manage my properties and they don't want to be part of the family business. Okay. So if I do sell at my stepped up base or my capital gains that I'm going to pay is the sales price, purchase price of the home, purchase price of the home, any improvements I've made, bought it for 600, say I dumped in 50,000 to update the kitchen, and the cost or my expenses to sell the property, so real estate commissions and closing costs. So let's say I'm into it 700,000. And let's say I sell the property at the value of the $1,050,000, I'm going to pay long-term capital gains taxes on that difference, and at the tune of about $179,000. So I don't know about you, but I kind of don't want to throw $179,000 at Uncle Sam. I would rather pass that asset on to my kids. Any questions there?
I think you did a great job explaining that. I would just give a little disclaimer here that, Katrinka and I are not financial advisors with any type of financial advisor licenses, nor are we CPAs. So this is information that we've learned through life experiences and a heck of a lot of research and what our CPAs are telling us and what we've read on the IRS website. But you really do need to talk this stuff through with your tax advisor. And this is one of those things that you should really understand, because I see people sell a house and pay the taxes and give the money to the kids before parents pass on. And it doesn't make any sense to me. I can't understand it. And I think the only reason they do that is because they don't understand the massive savings, tax savings available with stepped up basis.
Agreed. Okay, so one of the big barriers for those, maybe some on this call, but most of the barriers to buy their first investment property is the upfront savings, the 20-25% down that you're going to need to buy it. So some of the ideas that you can do, we call it house hacking. It's the strategy of using mortgage guidelines to achieve multiple low down payment options to acquire properties, or generating income opportunities from renting rooms and units on a home. So some of the examples and ideas that we have for you are, you can buy a single family home and rent out rooms. I've got a client of mine that just purchased 2 properties right next to the University of Utah, renting out rooms, single rooms next to a university, like gold mine. And he's renting out individual rooms, and it's phenomenal what they're doing as a couple. And their sons live in one in each property, which is very cool. You have ADU, which is an accessory dwelling unit. You can add a basement apartment to your current home, add an apartment above your garage, casita, or a growing common term called a barn dominium, which is growing in popularity. So that's an accessory dwelling unit where you just add a rentable space to your current property that you're living on. How about buy a duplex and rent out the opposite side? You live on one side, primary owner occupied, rent out the opposite side. If you're single and frugal, why don't you rent out the rooms that you're not staying in your side? Make it pay off a little bit more. Kitty condos. This is the one I'm super passionate about. This is how I bought my very first investment property. But you can co-sign on a property with your kids. So my daughter was at the University of Utah, dorm, just staying in the dorm, and the food plan that they made us pay was like $1,200 a month. That lasted 1 semester. And so what we did is I started building my daughter's credit profile the day she turned 18. Co-signed on a car loan, got a credit card. Within 10 months of turning 18, she had a 760 credit score. We purchased a property. She's occupying as the primary resident in that property. You can put as little as 5% down if you'd like to. We're on the loan co-signed with her. So essentially the income and the assets to purchase that property came from me, but we just got our first investment property with only 5% down, and my daughter's living in it. And the cost to live in that is less than it was to live in the dorms. So kitty condos, that's a great one. Second home, you can purchase a vacation property, and when you're not enjoying the property and living there, you can do nightly rentals on it if it's allowed. Partner with a trusted friend. Maybe you come 50-50 with the cash to purchase a property. Consider investing out of state. This is a big thing in our area because investing in real estate in Utah is getting more and more challenging to be able to cash flow the properties for what the properties are costing us to buy. So you can invest in out of state, Midwest states that maybe have cheaper properties and cash flow better. Buy and move every few years. This is called the move up house. So buy a primary residence, put 5% down, live in it for a couple of years while you save up an extra 5% down or dip into the equity then, and purchase your next property with 5% down. The departing residence that you leave, convert it to your first investment property. Get a renter in there. Love that one. I have a ton of clients that do this one. And then the BRRRR method, which essentially stands for buy, rehab or renovate, rent, refi, repeat. Buy a property, rehab it, renovate it, rent somebody out, rent it out, and then you refi to dip it, because obviously the value of the property's gone up after the rehab. You tap into it with a cash out refi to get your liquidity out of that property. You use that cash out to purchase your next property, rinse, repeat.
By the way, there's a lot of loan vehicles out there for those renovation products. You can buy a beat up house, you can finance some of the renovation. Once it's done, you refinance into a permanent loan, pull some cash out if the numbers work for you, and then boom, you repeat and just go on and do the same thing. That's literally how my mom and I bought our first 40 houses. Literally just doing that over and over and over.
Awesome. All right. The other barrier that a lot of people are like, well, I just don't have the money saved up. So if you're looking at buying a primary residence, there's a lot of low down payment options out there. So if you're going to buy your property, then move up in a couple of years, you've got some conventional options called Home Possible, Home Ready. Those are only 3% down. You can buy a duplex, people, a duplex with an FHA loan with only 3.5% down. As long as your owner occupying one side, you can rent out the other side. Crazy. Every college student should do that. Conventional loans, obviously 3 to 5% down. We do a lot of physician loans. So we have physician products, 0 to 5% down. Utah Housing is a down payment assistance program, but every state has a program like that for down payment assistance. They're called bond loans. USDA loan, this is also 0 down. It's called rural housing is what you probably recognize this as, and it's a little bit more rural areas instead of in downtown metro areas. VA loans, if you have a VA benefit, 0% down, which is amazing. And then where the funds come from, you can get a HELOC on your current property to tap into the equity. You can do a cash out refi on your current property. You can borrow money from your current retirement account or 401k and pay yourself back interest, because a loan against your 401k isn't a distribution per se, because you're going to pay it back to yourself with interest. You can get a gift from family. This works on everything but an investment property, because you can't get gifted funds on an investment. But if you're buying a primary residence, you can. A Roth IRA, your tax refund. We can negotiate, which we're doing a ton of this right now, where the seller will cover your closing costs. So if you're short funds, we can help negotiate that. And then other people's money. Nice pool there. Any questions or comments there?
No, just some of those low down payment options are obviously for owner occupied properties, but the guidelines around an owner occupied property says that you intend to occupy the property for the first 12 months. So I've had a lot of clients that will, move in with these low or no down programs. They're in the property for a year or two. Sometimes they do renovation, then they buy a new property, right? Then they usually refinance to a lower rate. Then they move to a new property and rent that departing residence out. So you can use these vehicles multiple times as long as you move into the property and stay there for a year. You can literally build an entire real estate portfolio with very little down payment. Agreed.
All right, then versus now. So I'm sure everybody's asking themselves, do I buy a property right now? Like the recency bias that we have with COVID and what the housing market has done over the last couple of years, comparing 2020, 2021 to now. In 2020 and 2021, even up through early this spring, to get your offer accepted, we were quite frequently offering over asking price. We had competing offers. I had one client that competed against 94 offers on the same property. People were waiving all their contingencies, waiving financing and appraisal, covering appraisal gaps if it appraised low. Non-refundable earnest money to get their offers accepted. Yes, the money was cheap because interest rates were low, but low down payment offers on properties were being rejected. If somebody else came in and was offering 20, 30% down, you were outbid. So that's what the market was like over the last couple of years. Now, yes, money's a little more expensive because interest rates are higher, but we're seeing a shift that is a massive opportunity to buy right now. There's more inventory in the market. There's more protection in your contract because you don't have to waive all your contingencies to get your offer accepted. You have more negotiating power. Right now, it is very, very common. The lion's share of my contracts that are coming in have somewhere in the ballpark of 2 to 3% concessions being negotiated that the seller is paying to either permanently buy down their interest rate to make the property more affordable, solve the problem of affordability right now, or lower the interest rate on what's called a temporary buy down, where the first two or 3 years of owning the property is lower by 2 or 3%. So say the note rate is 7% and you do a 2-1 buy down. Your interest rate you're going to pay on the first year is 2% lower. So you're going to pay 5% interest rate in year 1, 6% interest rate in year 2. And then if you haven't refinanced by the end of 24 months, you're going to go back to the note rate of 7%. But sellers are paying that, which is making the payments more affordable for our buyers. So that's being negotiated. That was unheard of, guys, during COVID. Absolutely unheard of. But we're seeing it a ton right now. Marry the house, date the rate. Get committed to a property. If you can afford to buy it right now, buy it. Why not? You can refinance next year. Why not? That's what I did with my properties. Those 3 I bought this year, they all have high rates, but so what? I'll just refi them next year. And then massive opportunity for savvy investors. So you may not consider yourself a savvy investor yet. We'll get you there. It only takes a couple to get under your belt before you start to build some confidence in that. Any questions there?
Nope, well said.
So Fannie Mae, who is one of the foremost entities projecting what interest rates will be and have been pretty spot on historically, they published this story in CNBC stating that they project interest rates to be 4.5% next year. So if I buy a property right now, when the opportunity is massive, okay, I don't have to offer $100,000 over asking price to get my offer accepted. I take a little higher rate for the next year, but I can just refinance that property next year down to the 4.5% rate, which is super awesome. But the key points here in the article that they were referencing is a 30-year mortgage will fall to an average of 4.5%. Rates have jumped more than 2 percentage points, actually a little more than that, since the beginning of 2022, largely due to the Federal Reserve increasing borrowing costs. And consumers shouldn't necessarily delay a home purchase if they find an affordable home they like now, experts say. And I couldn't agree more. Any comments there, Josh?
Yeah, I mean, what people need to understand, what moves mortgage rates is inflation. So the reason why Fannie Mae is forecasting this interest rate is because they're seeing that inflation is starting to peak and likely to go down. Fannie Mae's economists also are looking at the overall economy and seeing that job growth is slowing, and we're likely moving into a slower economic expansion phase, and that will also bring down inflation. And that's why the mortgage rates are forecasted to go down. And the best mortgage rate forecaster that you and I know, Katrinka, is Barry Habib. Barry Habib has also been pounding the table that we're going to see peak inflation in November when we got the October CPI print, consumer price inflation print, and that rates should go down there. And Barry believes will be sub 5. So the best forecasters in the mortgage and bond world that I know are both saying inflation will go down, and that'll pull down mortgage rates. So I think people sometimes are going, wait, the Fed is still raising the Fed funds rate, but the Fed funds rate is an overnight lending rate. It has a fixed interest rate of one night. Mortgage rates are 15 or 30 years. Those aren't controlled by the Fed. Those are controlled by inflation. As inflation goes down, so will mortgage rates.
And I ask you this question. Think about this, guys. There's a lot of Americans sitting on the fence right now, paralyzed by the current state of the housing market and just absolutely fearful to step out of that fear and get into the market. I ask you this, what do you think the industry or the market's going to look like next year when interest rates are in the 4s? Do you think we're going to have opportunities to buy down rates and get concessions? Do you think the inventory is going to stay high or low? Guys, it's going to be a frenzy again. It's going to be exactly where we've been for the last 2 years. What I absolutely love about the market right now is opportunity abounds. Those who are not fearful are the ones that are out buying properties and building absolute massive wealth for their future, knowing that those properties, those mortgages can get refinanced in a short amount of time. When I closed on my 3 properties this year, I closed 30-year loans. I'm viewing those mortgages like they're 1 to 3 year loans. I just have to get to that step when rates drop down and I'm just going to refinance them. But by then, think of how much equity I've built at that point.
Yeah, great point. Hey, heads up, we're about 6 minutes over our time. So just
okay, you want
to
to take this one, Josh?
Sure. Yeah, I mean, I always like to not listen to the words coming out of their mouths, but watch where their dollars are going. And the media has definitely been negative Nelly on real estate, and I think it's a little bit ironic that Blackstone, as of July of 22, just puts the finishing touches on a record real estate vehicle. They raised $30.3 billion. So when everybody else is fearful as can possibly be about real estate, in fact, the most recent Fannie Mae poll came out that 93% of home buyers thought that interest rates were going to go up, and something like 80% said this was a bad time to buy a home. So when everybody's running, when the average Joe family is running for the door, Blackstone is running for the opportunity. So just kind of ironic to see what the average consensus is and what the billionaires are actually doing with their money.
Yep, agreed. I do want to touch on this slide really quick. This is what it looks like for those that buy and wait. They're wealthier than those who wait to buy. This is average cumulative appreciation since 1991. Find your state on this slide, but my state, I'm in Salt Lake, the highest appreciating state in all of the country. Those who purchased properties in 1991 have $621,000 or 621% appreciation. Find your state, it's massive. All of these look amazing. This is what it looks like to buy and wait.
And Megan had a question about, rents and will rents get unaffordable? Here's my advice. The reason why Utah has appreciated like that is because we're adding population amongst the fastest in the United States, and we're adding jobs at the fastest in the United States. So if you want to find a place to invest that's safe, find some place that has positive demographics and positive wage growth.
Agreed. Essence of time, I'm going to bypass that one. But here's another great quote from Warren Buffett. Be fearful when others are greedy and be greedy when others are fearful. Couldn't agree more. Get off the fence. So we welcome your questions. If anyone wants to come off mute and ask some questions, but I'm super passionate about real estate. I would love to sit down with each of you who are interested and create an investment plan for you. Let's see what you've got so far. Let's see where you're going, see what your goals are, what we can create together and build an investment plan for you. I invite you to hop out on my Calendly or reach out to me. If you scan that code on your screen, that will take you right to my calendar. You can pick a time. I would love to meet with each of you individually and help build it and start taking this step forward for you right now, rather than waiting. Any questions? Anyone want to come off mute?
I'm just getting a lot of thank yous and great presentations. And I would just echo what you said, Katrinka. We only know what we know. And sometimes we can only see what the reality is right in front of us. And sometimes just getting an opportunity to do an investment analysis and talk through things with Katrinka can bring up opportunities that you may not even know are available to you. We do have someone with their hands up. I believe, hold on, who is this that had their hand up? I think it was, there we go. Okay, I got M Heck. You should be able to unmute and go ahead and ask your question. Glad to hear from you. You might have to find your mute button on
This is
Zoom.
Mike. Hey, Mike. It's either at the bottom left of your screen or at the top right. There's a microphone. If you click on that, it has a slash through it right now. You'll come off mute.
Or just throw it in the chat.
That works too. Or call me Mike tomorrow.
All right.
Anyone else? I want to get you back to your evenings. Oh, Luke just rose his hand.
Hey guys, how's it going?
Amazing.
Great, Luke. How are you?
I'm doing pretty good. This presentation has been absolutely unreal. Y'all are sharing some baller information. I have a question, I guess, more specific to my personal scenario, because I am a lot younger. I just have not had the time to really build my wealth, build the savings. So what do you guys usually recommend as like a safety net for whenever you're starting to really get into real estate? Is it that 6 months reserves that generally most people talk about? Do you have more of like a preference? Are people thinking too much about what type of reserve they may need?
That's such a good question. And I think one of the biggest pitfalls for those who start investing in real estate is they don't have enough reserves or liquidity. Think of a scenario, not to scare you, but this is why liquidity and reserves matter. But let's say you're 12 months into your lease, your tenant is moving out, and it takes you a month to get it rented again. So in that month, you need to cover the mortgage payment because you don't have a tenant in the property during that little gap. And maybe the house, the roof leaks and you got to do some repairs on the property. You have all this happening all at the same time. So if you don't have a nest egg of those reserves like you referred to, you can quickly get into trouble in a hurry. And then you're having to rapidly fire sell your properties, which is something that we don't want to do. So yes, some reserves help and will definitely lessen the risk. The other thing that you want to consider is sometimes these properties, when you buy them right up front, they might not have massive cash flow in the first couple of years of owning the property. I've got a couple of my properties. I own 7 now. I've bought 5 in the last 2 years, and a couple of them barely cash flow. Like we're within like $100, $150 a month of break even, right? So I just have to plan ahead with some reserves just in case something breaks on the property, and that I can cover that. But knowing that I'm going to be able to increase that rent every year, every time the lease renews, I'm going to be able to increase the income on the property. So
Right.
Yes, reserves, definitely. I'd say a decent 6 months for sure.
Cool. Thank you so much.
Absolutely.
Hey, Katrinka, I'm going to leave you here with Colin to answer the rest of the Q&A. I've got a dinner I'm 15 minutes late for, but I really appreciated hanging out with everybody tonight, and I thought you did a spectacular job. Thank you so much for having me.
Thanks, Josh. Take care.
Take care, everybody.
Absolutely. Hey, Mike, were you able to find the mute button? No, anyone else that wants to come off mute and ask any questions? All right.
Hey,
So I'd like
Katrinka,
to- Oh, there
it's
we go.
Luke again.
Yes.
Are you using this slide deck to teach others as far as like agents, just other investors, maybe first-time investors, things like that?
Yep, absolutely.
Where did you get a lot of this information from?
Our own research, and we actually put the slide deck together as a team.
Awesome.
But a lot of the resources are widely available. So a lot of the calculators, you guys can go out and pull some of these calculators yourself. Like I said early on, go out to investor.gov. There's a ton of calculators there that you can use. Make sure that you're logging in and checking your Social Security personal account on what your projected earnings are going to be there. And then we just have obviously a ton of research that goes into these to coach and train clients and colleagues, but I'd be happy to co-present this data to anyone you want. If you want to get a group together, I can do private webinars. We can meet at a pub and you get 10 people there. I'd be happy to coach it, or bring groups of realtors together. Be happy to do that as well. So let me know if I can assist in that arena as well. What was that, Luke?
Thank you again.
Yeah, absolutely. Anyone else? All right, Mike, I will give you a call tomorrow to answer your question. It's been an absolute pleasure, everybody. Like I said, pop out on my calendar here and pick a time. I'd love to meet with each of you individually, and let's see what wealth we can build together. Cheers, everybody.